Hi, everybody. I'm Margie Meisonet with Federal Practice Group and want to welcome you, either if it's your first day today or if you joined us yesterday as well, to Multifamily Housing's Partners in Housing training. And this is a culmination of a training session that has been done for industry partners all over the country in 7 different cities. And so now we have the opportunity to do it here today in DC, a little webinar here. We'll have 3 modules today, which Gates is going to talk about. So with that, I'll turn it over to you, Gates.
Hi, I'm Gates Dunaway. I'm with Tapestry Development Group. We're a 501c3 nonprofit based in Decatur, Georgia, which is just outside of Atlanta. And we work with folks who are trying to refinance and reposition their properties, their HUD finance properties. Today we have an agenda that includes 3 modules. Margie's going to talk about renewing Section 8 contracts, and that's going to be from now until about 1, and then we'll take a break until 1:15, and we'll start at 1:15 with a module on FHA refinancing strategies. And after a break around 2:15, at 2:30 we'll start up with our last module, which is on tax credit refinancing strategies. We've been asked to read a statement in response to a few questions received about the audiovisual aspects of the presentation. We just want to take a moment to say that whatever system or technology each person is using to access this webinar can influence the general quality of the broadcast presentation on your end. We want this training to be valuable and helpful to everyone in their work with HUD multifamily properties. So if you are having technical difficulties, be assured that you can access these webcasts after they are complete on HUD's archived website. This link will be sent out to you once the training is complete. Margie?
Okay, thank you. Well, let's go ahead and jump right in with Lesson 5, which is preserving rental assistance through long-term contracts, specifically Section 8 in this module. We also will be talking about the rental assistance demonstration program. So let's start with our objectives. So the first one is we want to recognize the opportunity to renew existing Section 8 rental assistance contracts, known as HAP contracts, of course. We're going to analyze the requirements, incentives, and tools associated with the Section 8 20-year contract renewal, and explore 2 specific tools to get a Section 8 rent increase in conjunction with the 20-year contract renewal. So the first one we'll talk about is the markup to market, which is option 1 in the Section 8 renewal guide. And the second one we'll talk about is markup to budget, which is chapter 15 of the renewal guide, and it's also known as option 2. Continuing on, the other objectives we're going to cover in this session, we're going to evaluate the potential of these 2 tools for your property based on your situation. And then we're going to identify current options available for owners of properties with expiring Section 8 mod rehab contracts, rents up, and RAP. And that's the rental assistance demonstration program that I alluded to and that we spoke briefly about yesterday. So topic 5.1 is renewing Section 8 rental assistance contracts. And here we see a little bit of information on HUD Section 8 Renewal Policy Guide, and this is available on the Multifamily webpage. If you go under Section 8 Contract Administration, the guide is there along with additional information you might find useful. And the policy guide provides comprehensive guide, it's guidance for renewing expiring Section 8 project-based contracts. You can also find on that site actual templates, the contracts themselves are there. So it's a really good resource to have. So each Section 8 contract is renewed pursuant to the Multifamily Assisted Housing Reform and Affordability Act, which we call MARA, and rents are either adjusted with an operating cost adjustment factor, the OCAF, or budget-based rent increases. Contracts are renewed and rents are adjusted using various renewal options, and we'll talk about some of those today. You may be familiar with options 1 through 6 of the renewal guide. Again, today we'll be talking about options 1 and 2. And each property is eligible for different renewal options that sets a term for how the rents may be adjusted, but also the term of the contract. And when we were doing this training session in Denver and Chicago, sometimes folks weren't as familiar with it. Almost everybody in our sessions had Section 8 contracts, but a couple people asked what the other renewal options are, so I'm just going to briefly touch on those. So number 1 is markup to market. 2 is renewals of other contracts that are at or below the market rents. 3 is referral to the Office of Affordable Housing Preservation. That's the mark-to-market program that we covered yesterday where the rents are above the market. 4 is for properties that were exempt from OAP, specifically like a Section 515 property or a Section 202 property, or properties that didn't have FHA insured mortgages. Option 5 is for portfolio reengineering properties. This was the predecessor to the mark-to-market program, demonstration programs, and also the 2 preservation programs we talked about yesterday, ALIPA and LIPRA. And then option 6 is opt-out. In this training session, we definitely will not be talking about opt-outs because that is not the goal. So, all right. So moving on, to respond to the evolving nature of Section 8 renewal legislation and policy, the individual sections within the guide are updated as needed. And I can think of 2 recent updates that occurred. I want to say one in May and one in June. So it's definitely a quicker way for getting changes out there. And then you can see the link where you can find the renewal guide. And then we won't be, once again, we won't be talking on all the renewal types, but just the 2 I previously mentioned. So back on July 15th of 2010, a gentleman by the name of Willie Spearman, he was at the time the director of the Office of Housing Assistance and Grant Administration, issued a memo. And really, the memo came out because while HUD for some time had the authority to do 20-year renewal contracts, there was some confusion in the beginning. Not all of the field offices always recommended the 20-year. Sometimes they might say a 1-year or a 5-year, and then some were more consistently advocating for the 20-year. So the key points that the memo raised was to confirm that owners may request 20-year contract renewals, that long-term multi-year contracts assist in preserving affordable housing, and that the field offices should suggest that the owners request the longest possible term for their Section 8 contract renewals. And in this case, typically 20 years. We will talk about a couple of instances where you can actually go above 20 years. So generally, the maximum term is 20 years. Here's a couple of exceptions. If you have an existing use agreement that controls the renewal options available to the owner, so then in that case, the term of the Section 8 contract is coterminous with the use agreement and may be less or more than 20 years. So the first bullet you see there, the maximum term of the contract for a Title II preservation project with the use agreement having a remaining life of 10 years is 10 years. Those are the ALIPA projects we talked about yesterday. So again, if there's only 10 years left on the use agreement, the Section 8 contract cannot be 20 years. It can only be 10 years. And then the second example we have there is for a Title VI preservation project. Those are the LIPRA projects we talked about yesterday. And so if the use agreement has 30 years remaining on it, then you can do a 30-year contract renewal. So now we'll go on to some of the benefits of a 20-year contract renewal. Stable long-term income stream. This is a form of credit enhancement that we've been talking about. I think lenders in particular like to see this, and investors. You're able to secure financing for needed repairs and remodeling. Annual rent increases and the potential to receive increased distributions. Reduce processing time and annual paperwork, so you're not doing a full-blown renewal every year. And then most importantly, preserves the long-term affordability of Section 8 properties. And there might be other ones on there, but these are some of the suggested ones that we came up with. And which, of course, leads you to a nice sustainable property. So looking at the benefits of a 20-year versus a 5-year renewal. So 20-year contract provides stability in rental income, protection from vacancies or other volatility in the housing market. The stable 20-year income stream is typically required by lenders, so it makes the property eligible for loans to do rehabilitation. And not to say that you couldn't do that with a 5-year, but you have the extra security of having a 20-year. So looking at renewing an existing contract, the question here is, I currently have a multi-year contract. Can I still apply for a 20-year HAP? And this was actually amended a little bit by one of the recent changes to the Section 8 renewal guide. You actually don't have to do the attachment 20 anymore. You can terminate and get a new 20-year contract, even if you're in the middle of a multi-year contract. So we talk about executing a new 20-year contract. HUD may be able to terminate the existing Section 8 contract because the owner would like to enter into a 20-year, and the remaining time in the existing contract is added to extend the term of the contract. So when we talked about the LIPRA properties before, that was one exception where you could go beyond 20 years, and this is another one. So if you have your new 20-year contract, add your remaining years in the current contract, and then you have your new term. And the example cited here, the owner has 2 years left on their contract, and they want a new 20-year, so they'd get a 22-year contract. And obviously, the thing that we always keep in mind with this type of subsidy and other types of subsidy is that funding is always subject to appropriations. So the good news is that at least as long as I've been doing this, Congress has never not funded it. So, but there is that caveat in there. Okay, here are some other examples where a new 20-year contract might be possible. An original contract that has not yet been renewed under MARA, so, it's in the late 90s, where there's just a few years left on the contract. To terminate the contract early for the purposes of executing the 20-year renewal, a HUD-approved waiver issued by HUD headquarters is needed. And then a MARA renewal contract in the midst of a multi-year term where the owner is doing a long-term preservation transaction. So that's similar to the example we covered in the previous slide. Owners have to agree to execute a 20-year contract that includes a preservation exhibit stating they will add the years remaining on the current contract to the end of the new 20-year contract term. And then HUD recently issued Section 8 Renewal Guide page changes that provide more guidance on this process. And one of the things I really like about the Section 8 Renewal Guide, as opposed to the old days where there was always a new housing notice that provided the changes, is that when one comes out, there's always a transmittal page that explains what the current changes are, and then the text is actually highlighted, usually in gray, for what's changed since the last version. So it makes it very easy to see what the differences are. So how to apply for a 20-year HAP renewal. You're going to complete the following documents, specifically the contract renewal request form you see on here. That's Form HUD 9624. You pick your option and then specify the 20 years, because of course we're talking about 20 years. There's the link where you can find that. And again, to me, the easiest way is to go to HUD.gov, go to offices, housing, multifamily, Section 8, and everything's right there. And there's also a link for preservation that's very useful that we've talked about over yesterday's sessions. And then any accompanying documents, you can check with your performance-based contract administrator or your traditional contract administrator for a list of the required documents, depending on the option that you use. That information is also in the renewal guide. So here's a typical renewal. You're going to submit the cover letter and all the necessary documents to the contract administrator or your HUD project manager. I know that at the time I was working at HUD, when the contract administrators, the PBCAs were originally brought on, and HUD did retain the option to keep the contract administration of the contract, although that was pretty rare. So I'm not sure today if HUD administers any of the contracts, but it is possible. So for most renewal options, you also be required to submit a rent comparability study. Those are generally good for 5 years. If you're submitting a budget-based adjustment for the rents, you also need to submit an operating budget. And if you're obtaining a new loan for the property, you will include the estimated, the new debt service in your budget-based rent calculation. So looking at required documents a little more specifically for contract renewals, the owner's letter covering, cover letter stating the purpose of the proposal, then your attachments of the supporting docs, the contract renewal request form that I mentioned, rent comparability study, a budget worksheet, and that's the HUD form 92457A, and an explanation for increase in expenses over 5% or $500. So you're looking at, what your actuals, 5% over your actuals for last year. So if you're submitting it this year and one of your line items goes up $500 or 5%, then a nice narrative statement explaining for the changes is needed. Then a signed request for an increase in the reserve for replacement account if needed. I always think that should be a given. I think that should be mandatory, because I remember seeing so many properties where I think it's more automatic now, but back in the olden days when I worked at HUD, it was not unusual to see properties where they'd gotten rent increases, but the reserve for replacement deposit was the same as it had been when the project was initially endorsed, and then years later, you have all these capital needs, and you didn't always have the funding to make them, at least in your reserve account. All right, moving on to, you're also going to include a notice to tenants to renew the contract delivered to them a year ago, a utility analysis, and if you're requesting a budget-based rent increase, the tenant notice of the 30-day rent increase proposal to HUD. And then also, if you're requesting a budget-based rent increase, the owner's certification as to compliance with the tenant comment procedures, and those are found at Title 24 Code of Federal Regulations, Part 245. So looking if rent comp study is required, well, I still need to submit a rent comp study every 5 years if I get a 20-year contract. And the answer is probably. So it depends on the renewal option that you pick. Generally, because today we're speaking about options 1 and 2, that for both of those types, typically, yes, you do need to submit a rent comparability study, and you can follow up either with your contract administrator or your project manager for additional guidance if you're not sure. Okay, our next topic is topic 5.3, 20-year contract renewal. This is option 1, markup to market, for profit-motivated or limited distribution mortgagors. So the minimum term is 5 years, but of course, HUD is encouraging owners to select a 20-year term when possible. Here's a little overview. It's a critical preservation tool for both owners and HUD. It was originally introduced in June 1999, and it became permanent under MARA in 2000. This was actually emergency legislation because what was happening at the time that in your stronger housing markets, owners who didn't have, like the nonprofits who were required to maintain the properties affordable in the stronger markets, if they couldn't get their rents marked up to market, and they did have the option to opt out, and they still do today, but this was really intended to encourage them to stay in the program. And then owners can obtain a rent increase up to comparable market rate rents for all units covered under the project-based Section 8 contract. Owners can benefit under this option from access to increased distributions. I mean, this is really specifically to the limited distribution owners, because the profit motivated can take all surplus cash, but in this case, limited dividend owners can get a higher distribution. It's an effective tool to recapitalize and preserve properties as affordable housing. For market rents, owners are not required to submit budgets to HUD. And then Chapter 3 of the Section 8 Renewal Guide provides the latest guidance on this program. So looking at within option 1, you have option 1A and option 1B. And option 1A is really the mandatory provision versus option B is discretionary. So again, under option 1A, the Section 8 contract that received its initial renewal under MARA or is renewing under MARA for the first time is eligible. You have to have a physical inspection score conducted by the Real Estate Assessment Center. The score has to be 60 or higher with no exigent health and safety deficiencies. The ownership has to be profit motivated or a limited distribution entity. The market comparable rents for the property that are, well, the rents are either at market or up to 150% of their fair market rent potential, and that's that cap. The 150% of the fair market rent is your cap. Then the ownership has to be free from low and moderate income use restrictions that cannot be eliminated by unilateral actions by the owner. For example, if you have a rent subcontract, flexible subsidy use agreements, or low-income housing tax credits. So again, this is to encourage those folks who could walk away to stay in the program. Option B, this is the discretionary one where you have to ask for, you have to come in and get it pre-approved. So this is what HUD looks for. Generally, you just have to meet one of these criteria. The renewal guide does say that if funding is limited, HUD could require folks to qualify under 2 of the criteria, but to my knowledge, that's not currently happening. So the first one is vulnerable populations. If the property has, must be of a particularly vulnerable population, and that's defined as at least 50% or more of the units provide housing for the elderly, disabled, or large families. Vacancy rate, the property must be located in a low vacancy market area where there's a lack of affordable housing and where Section 8 vouchers would be difficult to use. HUD defines a low vacancy rate as 3%. Community support, the property must be a high priority for the local community as demonstrated by contribution of state or local funds to the property. And then we want folks to note that discretionary markup to market requests must be reviewed and recommended by the HUD field office and forwarded to headquarters for final approval.
Can I ask a question?
Sure.
Is option 1B, we get this question a lot, option 1B is a way for a nonprofit entity that may not qualify under option 1A to go after an option 1 markup to market?
That's correct.
Is that how it's used? Okay.
Instead of going to like your markup to budget.
Right, okay.
Yeah. All right, so if you're requesting a markup to market renewal, you can request it at any time. You don't have to wait for the contract expiration, but the carve out on that, if your contract's expiring, you have to give HUD at least 120 days to, or your contract administrator to renew a contract, but you don't have to wait till you're getting toward the end of the contract term. And then with your markup to market request, include a request for discretionary approval under 1B if you don't automatically qualify for a 1A renewal, and request a 5 or a 20-year contract. So determining the final market rent levels under this option For Section 236 and D3 Beamer properties, market rent levels will be reduced by the level of interest reduction subsidy attributed to each unit type. There are some exceptions to this under a 230 decoupling. I should have mentioned that yesterday as well. In some cases, HUD will waive that under certain preservation transactions, but generally, you're going to reduce the debt service by the amount of subsidy you get on the mortgage for those two property types. HUD will generally cap the new marked up rent levels at 150% of the fair market rent and approve an increase in the annual distribution equal to the difference between the current rents and the new marked up rents, instead of basing it on the initial equity for a limited dividend owner. And then for properties with 100% Section 8, HUD will allow owners to distribute 100% of surplus cash at year end. And contracts will receive rent adjustments under published operating cost adjustment factors. So now let's go on to our second option we're going to cover today, and that's option 2, or chapter 15 in the Section 8 renewal guide, and that's markup to budget for nonprofit Section 8s. And also, Gates, related to what you were saying, if you could have like a tax credit property, or where one of the partners is a nonprofit, but it's a for-profit entity overall, those could also qualify for an option 1A. All right. So this option, also known as option 2, is designed to facilitate ownership transfer to nonprofit purchasers and or capital repairs by nonprofit owners. Rents may be increased on a budget basis for acquisition and or rehab costs subject to the market cap. So previously in the first option it was 100% of fair market rents. Here it's the market cap. Then pursuant to the 2010 Spearman memo, HUD may approve rents at the post-rehab rent level. So it's the rent that the unit will be able to get once the repairs are done. But those rents will take effect after the rehab is complete. This is only available to nonprofit purchasers and owners, which may include nonprofit-controlled, for-profit, or limited dividend entities. Then the final note on there might be a little harder to read. It says a nonprofit-controlled partnership, this is what I was mentioning to Gates, or LLC may elect to proceed under either markup to market or markup to budget. Here are the eligibility requirements for Chapter 15 or an Option 2. You have to be a nonprofit with a charter under the state law, or in certain cases, a profit-motivated organization if a waiver is provided by HUD, and I believe that relates to how the documents were originally executed when they acquired the property. You have to have 501c3 tax-exempt status, except for limited equity co-ops or projects where the status was not previously required to participate in a HUD program. Financial solvency with no unresolved audit findings. Then a REAC score greater than 30 for capital repairs or greater than 60 for transfers without capital repairs. Additional requirements for nonprofit purchasers under this option: you have to have previous ownership or management experience with affordable multifamily housing. And then community ties, so if you're a national or regional nonprofit, you have to joint venture with a local nonprofit or secure majority tenant support. Required documents under this option include a budget-based rent increase application, because you are marking up the budget, so of course you need a budget, a rent comparability study showing the as-is market conditions and after rehab market conditions, a capital needs assessment prepared to HUD specifications, a sources and uses statement, and then a detailed description of the proposed transaction, including documentation of site control if the property is being transferred, and documentation of rehab costs for the capital repair component. All right, so your components for a budget-based submission for Chapter 15, you're going to cover repairs, an increased reserve for replacement contribution and or debt service on a new rehab or acquisition loan, and again, all the costs must be budget justified. In terms of distribution, HUD regulations generally prohibit cash distributions to nonprofit owners of subsidized properties. But this doesn't apply to nonprofit-controlled limited partnerships or LLCs, is the note under there. Under markup to budget, nonprofit owners may apply for a regulatory waiver to receive a distribution equal to 6% on initial equity, and I know that is a newer policy. The required contract term for Chapter 15 renewal is 20 years, but then HUD also requires a use agreement that extends for 20 years beyond the term of any existing federal affordability restriction. So if you already have a use agreement, or if you have tax credit property, and you already have affordability restrictions on there, plan to tag on another 20 years. Most but not all existing post-MAR contracts may be terminated early and replaced with the markup to budget contract. And then HUD will also terminate and renew an existing markup to budget contract, starting at the current rents for up to 20 years at the owner's or the purchaser's request. All right, rent determination under this option. When rehab is scheduled, rents may reflect the post-rehab market comparable rents if greater than the current rents. The higher rents won't be effective until the critical repairs, if you're doing mod rehab, or the entire construction scope is completed if you're doing substantial rehab is completed. So mod rehab, you got to finish the critical repairs. Substantial rehab, you have to complete the entire construction scope to get those higher rents. During the contract term, rents will generally be OCAF adjusted up to the OCAF adjusted market rent cap. Rents will be readjusted to market up or down every 5 years based on the new rent comparability study. So whatever the rent determination is in the rent comparability study, that also gets adjusted by the OCAF factor, in addition to the rents at the property. The tenant portion of the rents at any non-Section 8 unit, so if you have a property that's not 100% Section 8, may be increased up to 10% in conjunction with the transaction. If you want to request a Chapter 15 contract, you can request it at any time. You don't have to wait for the contract expiration date. But again, the 120 days, does still apply. And conceivably, you could still submit it within less than 120 days, but it might not get processed in time. No. So let's look at some renewal options for nonprofits. On the left there, you see markup to market, option 1B. You don't have to submit a budget. There's no limit on rents for non-assisted units, and you don't have to show a need for capital repairs. Under the markup to budget, option 2, or Chapter 15, there's no need for discretionary approval that is required for option 1B. So you might not qualify for a 1B. I went through the criteria before, the vulnerable population, the low vacancy rate. This is pretty much automatic, and you may be able to get a budget-based rent increase based on the post-rehab rents versus the as-is condition of the property. So with this, I'm going to turn it over to Gates, who's going to walk us through this activity, and I'm going to attempt to give her the right answers. Yeah.
I get to ask the questions. All right, so for those of you that are joining us for the first time, we have these activities scattered through these modules to help cement the lessons that Margie's been teaching us. So we're going to, if we can go back to the slide, we're going to go through the activity and then get to the end of the activity and then ask questions to you. So this is the characteristics of the property. We're trying to determine the most feasible Section 8 contract, either the markup to market, the Chapter 15 markup to budget renewal option to use to preserve this affordable multifamily housing property. We also want to determine the rationale for choosing which option renewal. And then we want to list the potential benefits that can be realized through a successful Section 8 contract renewal for the property. And then we have a second property to do this on. So we'll linger on this slide for a minute. This property 1, which we're going to go through and then ask questions of. It's located in a Midwest city downtown.
It's in Chicago.
Okay, it's in Chicago, she confirms, which is a strong market. The building type is an adaptive reuse to housing, and we're going to say it's family housing as opposed to, I suppose, senior housing, 79 units. It is subsidized with no HUD financing. The primary financing is the State Housing Finance Agency loan, we presume. The property was purchased in 1981. The company owner is a limited dividend owner. The Section 8 was originated in 1979, January 1979, and it expires in January of 2019. It's under its original contract phase, and it assists all of the units, all 79 units. There's the name of the program, and then the rent to FMR ratio is 123%. So the rents are 123% of FMR. And then it says it's below, the Section 8 rents are below the comparable market rents. So let's let that sink in for a second while I let Margie think. Here are the questions. The first one is characteristics of property 1, and then we're going to ask for the best option for renewal, and then the rationale for choosing the option, and then the potential benefits. So let's talk about the characteristics. What would you tell me out of that description that we gave What are the important salient facts that we can derive from that?
Well, one important one that immediately jumps out at me is when you're determining eligibility, the first thing I look at is that this is a limited dividend ownership entity
Okay.
versus a nonprofit or profit motivated. So right there, that kind of gives me a clue as to where I think I want to go.
Okay.
I also see that another critical piece to me is where the rents are in relationship to not only the market, but to the fair market rents as well, and that it's 100% subsidized.
Okay. So based on some of those critical elements, what do you think the best option is for renewal?
I would pick option A,
And
the
why?
markup to market.
Option 1A?
Option 1A, yes, thanks. Because you have the potential, well, a couple different reasons. One, you can mark up the rents up to 150% of the fair market rent. It doesn't say how below the comparable market rents are, but you're certainly looking at a rent increase either way, either up to the market or up to 150% of fair market rents. And the other thing I like about this option, for a limited dividend owner, it does provide for increased distributions.
Okay.
So to me, those are the biggest factors.
And they don't have, it's not discretionary.
It's not, yes.
They've got the right to.
Exactly.
And then the benefits you just said, I think, is the more like the automatic rent increase through the fact that they're not maximizing their rents.
Higher revenue and increased distributions.
Okay. All right, let's look at a second property. You can go back to the slide. This property is located in a southern city near downtown. I'm from Atlanta. We can pretend like it's Atlanta. It's
fair.
in a moderate market, which we have sometimes. It's a high-rise elderly building with 196 units. It's an insured, subsidized property category, HUD insured loan. It was purchased in 1970. There's a nonprofit owner. The Section 8 inception date was 2004 with an expiration date of 2012. And so it's in its renewal phase, we can assume. 153 of the 196 units are assisted by the Section 8 LMSA program. We'll let that sink in. We have another slide that shows you some more details.
And that's a loan management set-aside contract for those who might not be familiar with it.
The LMSA.
Yes.
And then continuing on, the rent to FMR ratio is the rents are 84% of the FMR, the fair market rent. The Section 8 rents are equal to comparable market. The initial endorsement date is 1973. Final endorsement date was 75, basically that's completion date. The original mortgage was just under $3.5 million. The date of the first payment, which I'm not sure why that's relevant, is 1972.
Sometimes we like to
We're throwing in
extra
more
little
stuff.
nuggets in there.
The mortgage matures in 2014, December of 2014. The mortgage term, in terms of months, was 474 months. The interest rate at the time currently is 8.5%. The current principal and interest is $25,000, over $25,000, and the principal balance on that mortgage is just under $1 million. So it's and it's also a 236 loan, which we could have almost deduced ourselves. So let's leave that up for just a second, and then we're going to ask the same questions. In fact, I'll leave that up while we're talking. The characteristics of property 2, what we think the best renewal option is, the rationale for choosing that option, and then the potential benefits. What do you think, Margie?
Well, what I like about this one is, well, it's a nonprofit. We don't know that it's the nonprofit arm of an LLC or something, so I'm going to assume it's a straight nonprofit. And you could go for option 1B, but I think option 2 might be a little better because it's not discretionary. I think you also have, I'm going to kind of jump into some of the potential benefits, that if the current rents, so if the property needs rehab, and so if you're doing a Chapter 15.
It's an old property.
Yeah, it probably does, and it's in a moderate market, so maybe that would help. So even though the current rents are at the market, that if there's going to be a repair program, you could conceivably get higher rents at the post-rehab rent level.
Which you're not able to take advantage of under option 1B?
That's right. There is also provision, I don't remember if we discussed it here, but there is a provision where HUD can also previously, oh yeah, we did cover it, where previously nonprofit owners could not receive a distribution, but HUD will consider waivers to 6% of that equity amount and allow the nonprofit to take a distribution. And then I previously mentioned no discretionary approval is needed under option 2 or Chapter 15.
So under option 2, they could potentially get a rent increase that they wouldn't be able to get under option 1B.
Right.
Through the idea that they're going to do enough rehab to increase
support the higher rents.
Okay. Okay. Back to you, Margie.
Thank you. So here we have a few tips for successful contract renewals. Accurate and timely processing of contract renewal requests is of the utmost importance in order to avoid delays in subsidy payments. Contract administrators and HUD field offices will work with you to ensure that your contract renewal request is prepared in accordance with the HUD guidelines. Contract renewal requests are due to contract administrator HUD, or the field offices 120 days before the expiration date. Reminder letters are sent 2 months prior to the due date. As a recommended best practice, start preparing as soon as you receive the reminder letter, so this could be a time-consuming process. Okay, our last topic for this section is the Rental Assistance Demonstration Program, affectionately called RAD. And today we're going to talk about preservation tools for rent sup, RAP, and Section 8 mod rehab projects, even though RAD has another component for public housing as well. You can find a ton of information about RAD on the HUD website, hud.gov/RAD. And they also have a listserv, so they'll provide you with updates if you think this is something you might be interested in. There's archived webcasts that you can view on HUD's website as well. And currently, the notice is going through, it was out for comment, and HUD is reviewing the comments, and the final version of the notice is scheduled to come out sometime this month, so stay tuned for that. So some of the provisions that are in here, it's possible that they'll change. I'm not sure how likely that is, so I'll proceed with that little warning. So RAD specifically addresses what's known as 3 orphan programs. Just because there was no way to go ahead to renew these contracts, there's really no successor programs to them until now. So the first one is rent supplement. And this was a precursor to Section 8. Rent sup was provided with some original 236 and 221D3 Beamer mortgages, and what was happening with those programs, and the same thing with the rental assistance payment, which was created in 1974. This was primarily to Section 8 properties that were experiencing financial problems, because back then, I mean, the rents were set not only to provide, to cover operating costs and a slight return to the owner and cover debt service, but also during high inflationary periods, the rents were exceeding the tenant's income. So this was an additional form of subsidy that was provided to alleviate that situation. And then the third program, the Rubik's Cube program, maybe I'm not sure what that means, but anyway, this is the mod rehab program, and it was authorized in the 1980s. Thousands of units were developed under this program. It was subsequently discontinued. There was a bit of a scandal involved in it, which I won't get into. I wasn't there, but anyway, it was actually considered a pretty successful program until Congress repealed it. So let's talk about rent sup and RAP extensions. HUD does not have the authority currently to renew rent sup and RAP contracts when they expire. Under recent appropriations acts, HUD may authorize short-term extension of existing expiring rent sup and RAP contracts for terms up to 12 months. So it's not considered a new contract, it's just considered an extension of an existing contract. So contract has to be expiring. If the contract is terminating due to a prepayment or another reason, it's not eligible for an extension. Under these provisions, the owners must be in good standing, including having a REACT score of 60 or above. And then the contract is extended at current rents. There is no provision for rent increases. All right, so if there's an underlying HUD mortgage that will mature within 12 months, HUD may only extend the contract out until the maturity date of the HUD mortgage, because there are also some non-insured properties that have rents up and RAP. If there's no HUD mortgage or the mortgage maturity is beyond 12 months, the contract can be extended for a full year from the date it would have expired. So for example, if the expiration of the contract is July 1st of this year, the contract can be extended so it expires on July 1st of next year. These extensions will be considered as long as funds are available. HUD will not consider extensions more than 6 months ahead of an expiration date, and requires about 60 days to process the extension. So similar to Section 8, you want to get started early. The owner contacts the field office to request an extension, and the field office will provide the necessary contract extension document. So here's a recent change related to HUD's authority to provide vouchers. Until recently, HUD provided tenant protection vouchers when a rent subcontract expired or was terminated, but not when the RAP contract expired. HUD now provides regular vouchers for all units on the original rent sub or RAP contract when these events occur. And in some projects, there may be a certain number of units on the original rent-sup or wrap contract, but only a small number are actively billing. HUD will provide tenant protection vouchers for all units on the original contract, even if the units are not actively billing as a rent-sup or wrap units, as long as the units were occupied in the 24-month period prior to the contract expiration or termination. And this is not all that unusual where owners are not billing for 100% of their units, but it's nice because if you have 20 units and you're only currently actively billing on half of them, on 10 of them, but let's say in the last 24 months, maybe 18 were occupied, HUD will provide vouchers for all 18 units. So the new program we're talking about again is RAD, and you might have been familiar with some of the predecessor ones that were originally proposed, including Petra and TRA. There are some substantial differences to them, but also some similarities. And the main body of RAD provides HUD with temporary authority, because it's a demo program, to convert up to 60,000 units of public housing or Section 8 mod rehab to long-term project-based vouchers or project-based rental assistance renewable under MARA. And again, the final notice is expected to be published sometime later this month. RAD is assistance for the orphan programs we talked about, and through the Merkley-Brown Amendment provides authority to provide project-based rental assistance in the form of project-based vouchers for the orphan programs, rent-sup, wrap, and Section 8 mod rehab. And there we have our two senators. And I used to think it would be kind of cool to have legislation named after me, like.
I don't know, Margie.
I think like the Dunaway-Mysonet Amendment.
Maybe we can talk about that later.
But then I think of Sarbanes-Oxley. I'm like, okay, that's a bad idea. Never mind. All right, so I've gotten over that moment. All right, so project-based vouchers or PVVs. These are Section 8 housing choice vouchers that a PHA housing authority agrees to link to a specific property, providing rental assistance at the project level. Typically, you think of it at the tenant level, not the project level for vouchers. The owner contracts with the housing authority, not with HUD. The housing authority manages the waiting list for the occupants. After 1 year, the tenant may move and take the voucher. The housing authority fills the vacancy at the property with another voucher holder. The owner may screen voucher holders referred by the housing authority so they can do their own check. The PVV contract term may be up to 15 years, subject to appropriations, and is renewable after that 15-year term. The rent limit is generally 110% of the FMR or any accepted payment standard approved by HUD. Then the long-term contract supports financing against income stream. Again, another nice form of credit enhancement that both lenders and investors like to see. Now, here on this slide, we're talking about project-based voucher limitations, and I want to stress these are current legislations that existed prior to RAD. So previously, no more than 20% of the housing authority's voucher funding could be used in a project-based format. No more than 25% of the units in a project can have PBV assistance unless the property has 1 to 4 units, or serves elderly or disabled family occupancy, or where supportive services are provided. It's a competitive selection to have your property, a competitive process to get your project selected. And then you have to conform to the PHA's goals of deconcentrating poverty and expanding housing and economic opportunities. So in essence, this is something that a housing authority would say in their plan that they're going to do it in order to be able to convert vouchers to project-based. So looking at RAD, provisions for converting to project-based vouchers, HUD is provided with short-term authority to convert tenant protection vouchers to project-based vouchers for mod rehab, rent-sup, and wrap projects in fiscal years 2012 and 2013. So if the contract, beyond that, right now there's no current authority to go beyond 2013. There's no limit to the number of projects that may convert, and there's no competition required. And again, if you do go and look at the RAD notice, I would say probably 75% of the text relates to the first part of it, which is really for housing, public housing units and mod rehab. That's the competitive process. And then the back end of the notice is the one that we're talking about today, and that's not competitive. The first part is limited to 60,000 units. There's no competition or no limit on the number of units on the piece that we're discussing today. So you have a couple scenarios. You could have a prospective conversion, the projects where the rent-sup, wrap, or mod rehab will The contract will expire or terminate due to mortgage prepayment during fiscal year 2012 or 2013, so going forward. But you could also do a retroactive conversion to project-based vouchers, where the tenants receive tenant protection vouchers because the contract expired or terminated after October 1st, 2006. So going on, the owner may convert these tenant protection vouchers to project-based vouchers under terms of the RAD notice. The RAD notice is PIH Notice 12-18, but it was actually signed by both the offices of Public Housing and Housing jointly, but it is a PIH notice. The benefit is that the project-based contract provides a stable source of income to the project for a 15-year term with renewal options. Under RAD, the Housing Authority has additional flexibilities with the project-based voucher program. Examples include, now they can have more than 20% of their vouchers be project-based. The owner can also cover more than 25% of their units with the project-based voucher contract. So if you want to apply for conversion to project-based vouchers, as described in the RAD notice, rent sup and wrap owners, if you want a prospective conversion, then you apply to the multifamily field office to convert the TPVs to project-based vouchers. And again, that's only for 2012 and 2013. Owners of mod rehab projects or retroactive rent sup and wrap projects, going back to that 2006 date that I mentioned, submit the application to the Housing Authority that administers the vouchers. So again, prospective, you go to multifamily. Retroactive, you go to the Housing Authority that administers the vouchers. And there's more information in the RAD notice on this process. So some of the provisions for converting to long-term Section 8 contracts. In addition to the provisions we just described related to rent sup, wrap, and mod rehab, RAD also authorizes HUD to convert public housing units or expiring Section 8 mod rehab units to long-term Section 8 contracts, either through project-based voucher contracts with the Housing Authority or a regular HAP contract with HUD that is renewable under MARA. And that's pretty rad, no pun intended. Sorry. I couldn't resist. And that's that first part of the notice that we talk about, that competitive process. And those, I guess that authorization, the regulations, and the implementation of that will not be final until the final notice is published. But the second part, which is the part we've really been covering today, that's already in effect. So back to the first part of the notice, just for additional information. This is the part that has the 60,000 unit limit through 2015. It's competitive. The new Section 8 contract must be paid for with funds transferred from public housing operating or capital funds or from the Section 8 mod rehab contract. So in other words, there's no new funding provided in the demonstration program. It's all funded through transfers of existing funds. So now we have a little activity. I'm gonna let Gates take over.
Okay. All right, so Margie, we're going to review a property, and then I want to determine the options with the optimal chance of success to preserve the property as affordable multifamily housing. Okay?
Right.
Ready?
I'm ready.
All right, let's look at this property. The property is a 200-unit Section 236 property located in an inner-city neighborhood. 50 units at the property are covered by a Section 8 Loan Management Set-Aside LMSA contract, 75 units by a RAP contract, and 75 units are 236 basic rents. The basic rents are 10% less than the Section 8 contract rents, and the Section 8 rents at the property are 15% lower than the area fair market rents, FMR. The RAP contract will expire in 2015 when the 236 loan matures. Tenants will get vouchers, but will likely over time take the vouchers and move to other more desirable parts of the city. The owner is concerned that they will have to reduce rents to keep the property occupied and will not be able to refinance the property at the level necessary in order to address the capital needs. So the question are, what are the options that this owner has?
Okay.
And I won't reveal any answers. I'll let you talk, and then we'll reveal as we need.
All right. So, well, one of my, what's the word? Issues. We do have a suggested answer in here that folks are going to see in a minute, which is why I'm discussing this. You know, one recommendation is to prepay and use RAD to convert the tenant protection vouchers to project-based vouchers. And then the provision to convert to PVVs is currently active. My only problem was, and I think they kind of threw this at me as a wrench to see, a little monkey wrench to see if I would catch that, is that I thought that you said the WRAP contract didn't expire until 2015.
Let's look at that. We'll go back.
Yep.
The WRAP contract expires in 2015.
Yes.
So
that was, there's a little trick in there. Luckily, I caught that.
So we'll reveal the first answer, and you'll
Yes.
tell us that it's actually got some complications.
It does have some complications,
It says
because WRAP
here's-
is 2012 and 2013.
Only available.
Yes.
Okay, so viewing audience, you notice that. So let's get past that one and talk about other options
Sure.
they may have.
So let's say that they actually could convert.
Okay.
Just to make it a little more interesting.
Yeah.
So, the rents would be set at rent reasonableness. They could qualify for a higher, rent. It's also, I notice make sure I have my facts right here so I don't misspeak. It's a 236 property, and I noticed that so if they prepay the mortgage, the 236, the non-Section 8 rents are only 10% lower than the Section 8 rents, so you could increase those rents up to 10% without
okay.
HUD approval.
Okay.
So that's another option.
Okay.
Also, if you prepay, you could provide the non-Section 8, non-Section 8 tenants with vouchers as well. So those are some other options.
I'll reveal the next bullet. It says the
Okay.
rents will be set based on rent reasonableness as an option. That's just
For
a given.
RAD.
For
Yeah,
RAD,
they
yeah.
want to go RAD.
All right. And then let's talk about the third. If the owner can prepay the 236 loan by right, they can get TPVs for the WRAP contract for the 75 units and for the Section 236 units for a total of 150 tenant protection vouchers.
Right, so, looking at the WRAP units, the 75, the issue on the RAD side was you could not convert them to project-based vouchers because it expired in 2015.
Right.
But if you prepay, you could still get vouchers for those
Under
units.
that program. Okay, let's look at the last part. If the owner cannot prepay the loan by right, if the owner is a nonprofit, they can get TPVs for the WRAP units, but not for the Section 236 units, for a total of only 75 TPVs.
That's
a
correct, because they're
nuance.
required to maintain those additional 75 units as affordable.
Yeah. Okay. How about I go through the review questions and get you to answer them?
That'd
Ha-ha.
be great, all right.
We're at the end of this lesson, and we always end the lesson with a few review questions. We have 3 here. The first is, which of the following are conditions required in order for HUD to be able to terminate an existing 20-year Section 8 contract? And circle all that apply. I'll tell you 2 apply, Ms. Margie.
Okay.
The first possible answer is the purpose of terminating the existing contract is to execute a new 20-year contract.
I like that one.
I think we talked a lot about that one. That one's right. The term of the current contract must have less than 2 years remaining in order to do this.
Yeah, I think you made that one up.
I
That's
didn't
not
make
true.
it up. Someone
I'm
else made it up. I did not write this. The third, the amount of remaining time in the existing contract will be appended to the new 20-year contract, resulting in the term of a new contract exceeding 20 years.
Yep, we definitely talked about that.
And then the tenants who live at the property must be notified in writing. I think that's a trick one.
Yeah, I mean, you have your 1-year, contract expiration notice to
That
the
you give
tenants
everyone.
as
But the
well.
correct answers given are the A and C. Are we in agreement on that?
We are.
Okay. The next question. A profit-motivated owner is applying for a 20-year housing assistance payment renewal under option 1 markup to market. When can the owner request the 20-year housing assistance payment renewal? Can they do it 90 days before their contract expires, 90 days? Oh, the same answer twice, 90 days before their contract expires, 90 days before their, oh, this is great, I
I'm
like
glad you
this, or
noticed
any
that.
time.
I think
didn't
I
read
like
ahead.
anytime.
I think the answer to that is any, I think the
I
key
think
here
we're
is
trying to
that,
prove a point.
yeah, no matter when it is, they can always get the renewal, or ask for the renewal. Going on to question 3. The newly passed rental assistance demonstration provides new opportunities for preserving properties participating in which of the following programs, and you circle all that apply. The rental assistance payment, the rent SOP, the Section 221D3, and the Section 8 mod rehab.
All right, well, it applies to all 3 except for C, which is the section 221D3.
You are right. Why don't you review your lesson objectives?
All right, so what we covered today in this lesson 5, thank you. We wanted to recognize the potential opportunity to renew existing Section 8 rental assistance contracts, which we did. We analyzed the requirements, incentives, and tools associated with the Section 8 contract 20-year renewal. We also explored 2 specific tools to get a Section 8 rent increase in conjunction with a 20-year contract renewal. Those specifically being option 1, markup to market, and option 2, or chapter 15, which is markup to budget. We evaluated the potential of the 2 tools for your property, and recognizing that, you know, everything we cover today in these activities and these case studies, your property might vary. So we're not trying to advocate that this is always the only right answer, but these are things for you to consider when you're looking to preserve your property. And then we identified current options available for owners of properties with expiring Section 8 mod rehab, rent sup, and wrap properties, and of course that was the RAD demonstration program.
Thank you, Margie. If you'll come back in about 25 minutes, we will be starting on our 6th lesson, which is a lesson on FHA refinancing strategies. That would be 1:15 Eastern Time. Thanks.